Hi everyone and welcome back to the channel and to another video. Today we're going to be analysing Peloton stock, a company that has been in the headlines in recent days for all the wrong reasons. And as you can see from their stock price, they're down 16% in the past few days. Now we will get into why that is in a moment, but whilst we're here, let's just look at the fall off that this stock has had in the past 6 months. Firstly, they were probably one of the biggest beneficiaries of the COVID-19 pandemic, as their products were a supplement for the gym and exercise classes whilst the world was in lockdown. And the stock price benefited from that, rising 175% in just 6 months. But in fairness, so did sales and member count as well, so it was justified to an extent. However, since around December time or late December time, the stock has been on a massive downward slope, peaking at around $162 to around $82 today. That's a massive 50% drop in just 4 months. So we're going to try and evaluate in this video whether the 50% drop from its high and recent 15% drop in the past few days have created a buying opportunity for Peloton stock. And if not, we will put a fair price, target price on Peloton, as there is a good enough chance that this thing could continue to slide. So firstly, let's evaluate what caused the recent sell-off, and this is the sudden 15% drop in the past few days that I'm talking about. So tragically, the proximate cause, not what happened in the past couple of days, but the proximate cause that's been brewing up was a child's death involving a Peloton treadmill. So from what I read, sounds like the child got stuck under the operating treadmill. And as a result of this and other injuries that had been reported and other concerns around the safety of the new treadmills, Peloton made a decision to recall 125,000 treadmills in the US. A big number, but it is my understanding that actually the units that were sold will be on a voluntary recall basis. So anyone who wants a refund will get a full refund, but anyone who wants to keep the treadmill can keep the treadmill. So the full financial impact in respect of lost revenues will remain unclear, but it will cost the business money in terms of lost production and money spent on marketing and advertising to push that product out there. So there is a valid concern around the financial impact on Peloton, although probably not in the realm of $7.4 billion, which is how much market value the company has lost since the start of the debacle, or even $4 billion, which was how much value they lost yesterday alone after they announced the recall of the treadmills. Which leads me on to another clear contributor to the 50% drop. If we look at what Peloton actually is as a business, come away from the near-term noise, and we need to look at the business anyway. They sell fitness equipment for you to use in your home and create fitness content for their Peloton app. So users can get something similar to a PT session in their home. So it's attractive. It's not just, the physical products, but it's connected fitness services as well. So that's their Peloton app, virtual sessions, and music platform, which make it a more unique product than anything else available, if we are being honest, all right? Especially in lockdown, better than anything else out there. But, and there is a but, the cost isn't cheap. So this is sold as a premium product. For example, the treadmills range between $3,000 and the bike close to $2,000. That's not including other accessory items that are available as well. And that's just the items. So this doesn't include monthly subscriptions that you have to pay to access all the classes and Peloton app that tracks your performance and goals. So to get the full experience, you have to pay a monthly subscription as well. And that will cost you anywhere from £13 to £39 per month. So even more if you're paying in dollars. And it's depending on the level of membership that you want. Essentially, the £40 one gives you a lot more, and it's basically a family membership compared to the $12.99 one, which is meant for people who might not even have a bike or treadmill that's from Peloton. They just want to use the app for the classes. And so like I say, not cheap. And I guess you can say that based off what we know now, Peloton's products are well suited to a shutdown economy. Not to say they aren't suited to a normal world, but they go from having essentially no competition in a shutdown economy or lockdown to having competition by way of alternative fitness solutions, such as the gym. And considering the cost of a Peloton being between, let's say, $2,500 and a varied $15 to $45 monthly subscription for the full Peloton experience, compared with a gym membership with classes being, let's say, an average of $50 per month, it doesn't exactly win on price. So the determining factors on whether they actually deliver value to the consumer and will be a sticky product over time will be the convenience of having fitness equipment and instructors in your home, right? How much will consumers value that in the next sort of 3 to 5 years? And so linking that back to the stock price, this makes the next 12 to 24 months really a make or break period for Peloton, with the world going back to normality, lockdowns ending everywhere all over the world. And will the growth continue in a normal world? We have to ask ourselves that. It is quite uncertain, I'd say, in my opinion. And I think investors are looking at the valuation and probably we're seeing too much uncertainty to warrant the $45 to $50 billion market cap that it was sitting at around this stock price here. And at this time, they were only doing 1.8 billion of revenue, which is a fair amount, but that's still, a chunky sales multiple to have on a company, especially when they're not yet profitable. And so I think the safety concerns were just a big catalyst to drive the stock down even further from that point. So here, I think the valuation was getting frothy, and then I think we had that scare with all of the recall and safety concerns, and that's driven the stock down 50%. But the good news is the stock price is now a lot less punchy than it was previously, and they've managed to grow significantly during that difficult period for the company. So if we look at their Q2 numbers that they put out, and they are actually reporting Q3 numbers tonight, I think, so you may have already seen the results if you're watching this video a little bit later. But at least these are last quarter's results, and they did give us full year guidance or fiscal year guidance for 2021, so we can look at that in a moment and tie it in with the valuation. But even during this difficult period, they managed to grow revenue 128% year over year to over $1 million in just one quarter, which is great and is their biggest quarter by far. I think you can see here their quarterly total revenue is growing every single quarter. If we take Q3 2019 out of the equation, revenue is growing very quickly every single quarter. So it's not just year over year revenue growth. And what's probably gone more unnoticed, and actually I was more impressed with, is they've managed to become profitable in the past trailing 12 months as well. Q2 net income was 63 million, which isn't bad. Adjusted EBITDA at 116 million, which is really good actually. That's an EBITDA margin of 11% for a company that last year wasn't even profitable and is still growing revenues at over 100%. That's a very good sign, I must say. So lastly, before we get into the valuation, let's just tie in some of the guidance that they gave for fiscal year 2021, because I think this really does help us with the growth story. And so for the fiscal year end 2021, which is the end of June, that's when they end their fiscal year, they're expecting 2.275 million or more connected fitness subscription, which is a very large amount. They're expecting 4 billion or more in total revenue, which is unbelievable growth considering the company only did 400 million in 2019. So in 2 to 3 years, that's a 10x in revenue. That's quite remarkable. Gross profit margin of almost 40%, which isn't bad. That slipped a little bit from the year previously, but more importantly, 300 million of EBITDA, which is good to see. So they are predicting profitability into the future around about an 8 to 9% margin. And so that gets us to our valuation. You can see here, I've got the past 4 years financials for the company and the trailing 12 months numbers as well. So actually only 6 months into the next year, they've almost managed to double revenue already. They're a $3 billion revenue company now. 2021 guidance I've got there around $4 billion, just because they've given us that, and we'll take them there on their accuracy. Thereafter, I've taken growth down to around 50% and then 35%, just because of that unknown aspect, of how quickly they can grow after the pandemic. Of course, we've got international expansion to think about as well. They're only in the US, UK, Canada and Germany at the moment, so they're looking to expand out of those countries, so that could fuel some growth as well if this thing really does provide value even in a normal world. That does get the company to around 15 billion in revenue as well, so not a small company by any means, and still a big ask to get from 4 billion to 15 billion in 5 years. So just because you're not seeing 100% growth doesn't mean that these growth rates are too conservative. Honestly, it is a very hard thing to do to grow at around 45% compounded for the next 4 years. And for margins, they're already at around 8% EBITDA margin going by the trailing 12 months. I think with some scale, they'll be able to get to around 10, so I'm not pushing it out too far really. They've only got a 40 to 45% gross margin. So for us to go to 15%, we probably have to have a very good idea of how they're going to get there. And I don't have that at the moment, unfortunately. So we're going to keep it at that. Free cash flow is good. They had 12% in 2020, trailing 12 months at around 18%. I'm going to take the average of those 2 years and just go with 15% as our free cash flow margin over the period. That's a nice stream of free cash flow that we should be able to receive over that time period. And one thing I did notice is the shares outstanding growing, so the share dilution. And what it gives us is this strange situation here where the stock price has gone from $130 per share to 84 in around 6 months. But actually the market cap has stayed around about the same because they've increased shares outstanding to 314 million from 221. So not great to see that they're diluting shareholders that much, but they have 2 billion in cash at the moment and not much debt. So they're well capitalized to grow into the future. They may need to raise shares outstanding some point in the future to fuel that growth again, but we'll see how that plays out. Going over to the DCF, going over to the terminal value. Just got a terminal value multiple of 25 times. It's a conservative estimate, yeah, but I'm comfortable with it. Do I think in 5 years Peloton will be selling under a 25 times multiple? No, I think it's very unlikely. So that's what I would like to go with as our realistic bottom. And that gets the company to around a $40 billion valuation. 40 billion plus, I'd say. There is definitely upside from this number. So take 40 billion as our base case. If we discount all of that back at 15%, then that gives us an intrinsic value for the stock today of 21 billion, or around $67 per share. So even after the drop, to get to our fair value and to get our required rate of return at 15% with reasonable forecasts, reasonable growth forecasts, not being too bullish on the company's future, then it needs to drop a further 24%, unfortunately. And look, I'd say it's not impossible that you will see this. You know, we've dropped from 120 down to 83. And obviously, you know, these stay-at-home stocks, if you like, the ones that had all the momentum back at the end of 2020 are really starting to sell off during this period. So we could see this drop back down to around $21 billion market cap. At the end of the day, $21 billion is still a very big company, especially for a company that is going to have $4 billion in sales. So that's 5 times revenue. In my opinion, that's more of a fair multiple to be paying for the likes of Peloton. And so that's about it for this video, guys. Target price or fair price of around $67 per share for Peloton. Hopefully it gave you some insight into how much value is actually being created after the drop or after the recent sell-off. Unfortunately, in my opinion, it still has a little bit more to go to get to our required rate of return, or for it to be a good investment for this channel. But I will be including this on the Patreon page and the Discord, so all of the members can play around with it and put in your own assumptions, see what sort of fair price you get for Peloton. If you're interested in getting that and also supporting the channel, and you also get many other benefits as well, then go over and check out the Patreon page. I'll leave a link in the description. If you could remember to like the video as well, that will help a lot. Subscribe to the channel if you haven't already, and I will see you all in the next video. Good luck with all of your investments.